Carissa Chappelle, and welcome to the monthly quick study of the REIT market with NAREIT's Brad Case. Thanks for joining us, Brad. As the holiday season gets into full gear, what impact does that typically have on the REIT market?
Well, the thing to keep in mind is that the stock market reacts to new information, surprises and the like. And what we saw in the last month is that the retail sector of the REIT industry did outperform the broad REIT industry. But it wasn't a month of very big movement in the REIT market in general. And so what that tells us is that investors weren't very surprised by what they saw in terms of retail spending. Maybe they were reassured, but it wasn't particularly new information. Now, looking on a longer term basis, if you look at the year-to-date returns, the retail sector has been one of the very strongest. Investors in retail REITs have gained nearly 24% over the year as a whole. So what that tells us is that although November wasn't a month of surprises for investors in retail REITs, they've been very happy with the earnings prospects for retail REITs and retail real estate going forward.
What sector stood out as having the strongest and the weakest performance?
Well, the strongest performers during November by sector were the self-storage sector and the lodging and hotel REITs. And that's actually especially interesting with respect to the lodging sector because that has been among the weakest performers year to date. And so what that tells me is that investors have been concerned about increases in vacation travel and business travel and both going forward. And during November, they became a little bit less concerned, a little bit more sanguine about the prospects for earnings growth in the hotel sector moving forward. In terms of the other side of the equation, the weakest performer by sector in the REIT market during November was mortgage REITs, especially home financing REITs. And that's interesting because when stock price movements are weak and dividend growth is still strong, that puts their dividend yield up at 12.5%. So in an environment where investors are casting about for investments that can give them strong dividend yield, mortgage REITs are an example of a very strong dividend yield sector of the economy.
There's been growing talk about the looming fiscal cliff. Will the fiscal cliff affect REIT dividends?
Yeah, it's very interesting. As I mentioned, investors are looking for investments that give them strong dividend yield, strong income, and REITs in general provide that. What's different between REITs and any other income equity that produces strong dividends is that other equities have the option to cut back on their dividends. REITs don't. REITs are required to distribute at least 90% of their taxable income. Now that doesn't mean they're distributing just all of the money that comes in. They're not distributing their revenues, they're distributing their taxable income, but it does mean that they don't have the option to say, well, I'm not sure about the economic growth going forward, so let me just sit on this pile of money for the moment. They have to distribute it to investors. And that means investors looking for strong income performing stocks can find it more dependably among REITs because as long as REITs are still earning income, they're still distributing it to their shareholders.
Thanks for joining us today, Brad. I'm Carissa Chappelle for REIT.com.